That is exactly on time. We are 1 o'clock Marty time, so it's perfect. So why don't we start with Nisha, then Thomas, and then Pete. Introduce yourselves, and we'll go from there.
Yeah, thanks so much, Howard. So Nisha Desai, I'm a solo GP and founder of an early stage investment firm called Andav Capital, based here in New York. We are a generalist firm investing in tech-enabled companies strictly for alpha. However, we look at underserved markets, founders who haven't had a lot of access to capital and SDG-aligned business models as misvalued sources of alpha. We have primarily invested in fintech marketplaces, software as services, but occasionally CPG when we see software-like margins. We've invested alongside and before PayPal CEO Dan Schulman, Kleiner Perkins, Morgan Stanley, BlackRock, and the strategy of the firm is really reflective of my own background. We invested in sort of underserved entrepreneurs. I am a first-gen self-funded college grad, grew up in the South, have blue-collar immigrant parents who were need-based entrepreneurs, and I think that there's a lot of potential in that archetype of a founder who's gritty and willing to run through walls to make money and livelihoods.
Cool. My name is Thomas. So I'm actually a venture partner in 3 funds right now. One is called Mana Ventures. It's one of the quite popular funds on AngelList. So Morgan Schwenk is the founder, and I recently jumped on board. And we've actually managed over 80 million assets over for now since 2016. And the first fund vintage, we're at a 10 time. It was pretty much Morgan's own money, and then we betted on, one of the very famous investment we did is Unity technology, Unity software. So I think we were in at a 1 billion valuation. So I'm excited about this fund. I'm also venture partner at Supernova Ventures with Laura Tooby, which is based in New York's early stage fund. We have about 45 portfolio companies and a level, between 5 to 15 million. And I'm serve as a venture partner. Scout deals, also bring clients and potentially raising fund 2. And the third fund is Longbrook Ventures. Longbrook Ventures is my partner Andrew and I, and Andrew is the sole founder. I'm serve as a venture partner and help out syndicate only funds. So every single deal we go out raise from our network and family offices and net worth individuals, including my own family office. And each deal we put in between $500,000 to 1.5 million into investment. We want to target early stage company, but we also wouldn't give up companies that are, just have an extremely good cap table, also extremely good founders. So for example, we were in Gemini Series B, and then I personally invested in People.ai with another fund, and that's backed by Andreessen, Iconic Capital, and also was recently raised 100 million last year by Mubadala. So those are some of the later stage, but early stage we've had some good exit. A company called Free Trade, which is sort of the European version of Robinhood, and then we were in early Con and also Monzo Bank. So I also run a single family office. So.
And what do you do in your spare time?
Work. And I do love sports. So try to get as active as I can.
Pete?
Thank you.
So thank you very much, Howard. So this is actually, I mentioned this morning when I gave the intro to Marty, I'm a partner at Polsinelli. My expertise is actually not in the VC area, and I'll tell you how my winding road to the VC area came about. But I've been practicing patent law for about the last more than 20 years. That's my real expertise. When I joined Polsinelli 6 years ago, I started hosting these family office meetings, some with Marty and some with others just in the business. And you quickly find out that all the companies, early stage and even medium-sized businesses need money. So I started hosting these family offices, and then I have clients that are both on a startup and in the family office investor space, where we share our deal flow. So that's my main area of expertise. Probably have 10 to 20 deals going on right now, and work with family offices and strategic partners, whether it be from big companies or elsewhere, to do it. And then and then I chair the med device group at work. So we're constantly looking at healthcare and med device. Biotech deals are very enticing, but for those of you that invest, especially early stage, it can be quite extensive to go through the money needed to get the data, needed to get the big money. So, but we're always looking at those deals and looking at some early animal data that's favorable, and then we'll partner with a bigger company. The exciting news for those of you in the venture space for me is I recently reconnected with some friends and colleagues at DARPA. Everyone is aware DARPA is a Defense Advanced Research Projects Administration. Most of everybody in the room is probably aware when the government gives money, it's also non-diluted money. So that's very exciting when we get those money. And I'll be working for them as a special government employee based on my background in the military and then experience working with companies and on the venture side. So it's very exciting. I could talk more about that as Marty? Yes, sir.
Do you have any relationship with Incutel?
Incutel?
You have a
Yeah.
relationship with them?
No, I know of them, Marty, but I think no, I don't.
Because
Yeah.
I expect them to expand greatly.
Yeah.
Because they're at 15 billion, I mean, so what they came and presented to us when they were like 300 million
Wow.
funding. We had a couple of analysts come and present, and now they're at more than 15 billion.
Yeah.
So, DARPA,
Yeah.
Incutel, I just got another contact from the US Army Ventures,
Yep.
so.
Yeah,
it's
and-
expanding.
Yeah. And I don't think she's on the agenda yet yesterday, but many of you, Thomas and I are friends and do some work together. So Olga Yermolenko is speaking tomorrow. And she's speaking about an opportunity in the quantum computing space and so on. So the stuff you do with DARPA is normally obviously national security related, but their investments are even broader, and they'll work with the National Science Foundation and many others. So those are the kind of fun things that I'm involved in.
Yeah, and Olga's super impressive too. She's one of the employee one on the Getty Quantum Computing, which is a public company right now. So yeah, she's a great person to have in your network and extremely talented.
So I'll give a quick introduction of myself. Howard Cohen. I'm with the firm Strategies for Wealth. We've been in existence for about 90 years, and no, I was not there then. My wife asked me, what is it like to always be the oldest person in the room? I said, at least I'm still in the room. So what we focus on is tax efficiency and helping our clients with their estate planning, wealth transfer in the most tax efficient way possible, generational wealth planning, dynasty trusts, estate planning. So hopefully that the money is going to stay in your family's estate in the most tax efficient way for multiple generations, up to 300 years. We'll see what happens if the laws change. But they keep saying that the laws are going to change, but in many ways, thankfully, they can't get anything through Congress, so nothing has changed so far. I also work with business owners on their exit planning, on their business continuity planning, executive strategies, and a lot of people don't consider how important retirement plans are for family offices, because there are ways to put away a lot of money for members of the family office, hundreds of thousands of dollars a year in a tax advantaged way. And a lot of people, when they're part of the family office, they just don't think of that aspect of it, and we can help in that area. So that's my quick commercial. Happy to talk to anybody. So I want to start out with any of you who participated in or listened to the session 2 sessions ago about distressed companies. I don't understand what all the stress is about, but we're in a distressed market right now. And one of the things in speaking with Nisha, she said to me that she's thrilled for this market. And I thought, how could that be? Why was anybody going to be thrilled for this market? So why are you thrilled for this market?
Yeah, I think there's been an entire generation, especially in the last 13 years, of the bull market of both investors and entrepreneurs who've only known things go up and to the right. They haven't lived through a recession, an inflationary environment, war, or rates rising this aggressively. So there will be an unlearning process whereby they are rattled by down rounds and layoffs and not being able to live in a Disney-like employment experience that they all feel is necessary. And so I'm actually thrilled for this market, and I've actually been waiting for it. And the reason for that is I focus on early stage investments and early stage venture. And compared to all other alternative asset classes, I haven't seen a dispersion in investment talent that is as wide at the early stage as anywhere else, right? So if you're investing in a market neutral hedge fund, it's kind of hard to sort of fake it till you make it. You either know you're good at running market neutral or you're not. In early stage investing, there's a lot of people who just had capital and were able to invest in the right time in the right place, and their paper returns look really good. And they've confused that analysis with investment acumen. So this type of environment actually will separate the wheat from the chaff, and shake out a lot of the tourists and folks like myself. I consider myself an elder millennial, so I do think there are a lot of Gen Zs and the other half of millennials that are really out of touch with reality and are entitled both from investment perspective and founder perspective. So those of us who came up in a different time as both investors and operators will see this as a welcome money-making opportunity, because we've been seasoned outside of this echo chamber in San Francisco and bull market.
So first of all, anybody who has any questions or just wants to jump in, feel free to do that. So Thomas, you think that, well, do you think that investors should be looking at the venture capital market? And if so, what percentage of their investments should go towards this?
Right. So, I want to add a little bit to Nisha, what Nisha said about early stage. So the reason, I'm in early stage as well, and the majority of my investments are in early stage. The 3 funds I work with, majority of our investments are early stage. A couple of reasons why early stage in this environment also works, and people should do that, because early stage, actually the company are having the lowest cash burn. So you're pretty much giving those founders and a team about 2 to 3, sometimes they're able to get 4 to 5 million funding to buy them time to create a product, create a software, and find the product market fit. So this is the period of time where actually, you're not going to see any sort of bankruptcy or distress, because the product hasn't really been done, and a lot of them hasn't really scaled up in hiring. So the 2-3 years, you're really just saying, hey, build me whatever you say it's on the deck, and build me whatever you think is going to be that superstar company. And then let's see if it works. If it does really work, then the next stage, you raise a bigger round of funding to scale up. And this is essentially true, very true in the software field, where early stage 2 to 3 million, a lot of times companies in MVP stage, or maybe the product's somewhat done in the demo stage, they will have a few large enterprise clients to sort of jump on board and say, hey, we want to try it. We're going to pay $50,000 to $75,000 to just annually just to be the first group of clients in. So in my opinion, early stage in this environment is actually more risk averse, right? It's usually the company that in the middle of the stage, they need that capital to grow, because if they don't grow, they have to fire people and they have to lay off and they have to sell themselves. So in my opinion, this is one of the major reasons why I think early stage in this environment is actually not bad, because let's say we're heading into recession, or maybe we're already in there. 2 years out later, we're coming out of it. So by the time we're coming out of a recession, companies actually are scaling up to grow. And you're pretty much buying them the time in 2 years, say, hey, by the way, you're going to have enough capital to sit through a recession, but just focus on making that product, making that software. And then by the time recession is done, let's go scale up and let's pitch the softwares, the products to the corporate, to your clients. And another reason I like B2B SaaS, I do really like the software field, is overall the gross margin is always good. It's probably between 70 to 90% based on how the company sort of projected. And a lot of them it's B2B. So think about corporate. What we learned from the 2020 sort of COVID is that a lot of the tech corporations or companies that have done well in the downturn, they actually have a really good corporate balance sheet. So they're able to spend and then use the software to improve their business model. And software is super sticky, and the switching cost is very high. So once you get hooked on it, they're very likely to renew it every year. So it's a really more of a subscription model that continue to cash flow for the company. So this is, in my opinion, why I think early stage is great for this environment. In terms of allocation in venture capital, I'll get to it right now. So I never got into bonds or fixed income. I do like private equity. I do like public equity. My parents are, our single family office, we own almost 80-90% exposure to real estate, mostly in condominiums or single family homes. We rent out some and we just host some. In my opinion, I do think the modern day portfolio should look like, it used to be 30% equity, 30% fixed income, and 30% real estate, and then 10% cash. In my opinion, I would take that 30% fixed income out and then substitute that with private equity. Because some of the private equity firms, they cover the fixed income part. So no matter if you invest in a real estate private equity or invest in a sort of distress focused private equity, I think that's a better bet than give it to the public managers who invest in fixed income. That's in my opinion. So if you do that, that leaves you, and then if you do that to the alternative, the 30%, you can take part of that allocate part of that into venture capital. So if you do, let's say 20%, so 20% into private equity, that leaves you 10% cash, 10% venture. I would do the 10%, you keep the cash, or others, I think that 30% should be allocating to venture capital space. And then the real estate, I would recommend you hold 30%. I think that's a great substitute for the bond market. They act alike, and in my opinion, their cash flow, their long-term. In my opinion, I think real estate probably provides more value from a long-term basis than owning like public bond managers in the mutual funds. So in my opinion, based on your risk level, you can own between 10 to 20% in VC, or 10 to 30 if you don't want any private equity. Because I think that 30% from bonds should be allocating to alternative. And based on your risk appetite, you can do 15% in venture capital and then the other 15 in growth or private equity, or you can do 10% in VC. Or if you're really risk averse, maybe you do the 10 and 10 and then you do 20% cash. So
You got that?
Yeah. Just jump on, I guess,
Yeah.
the common theme, the title, I guess, for this panel is venture capital. I think what's exciting for me is it's actually should be retitled the early stage venture capital, because all of us are in this area and the multiples are much higher. Obviously, the risks are much higher as well. I listened in on the full discussion about the distress side, and I understand all the concerns and everything they're saying about valuation. I quite frankly, unlike, of course, 2008 capital just for the most part shut down, I haven't seen too much of a change in the capital. There's always going to be significant scrutinizing of the deals, and the valuation is always going to go up and down, especially in early stage pre-revenue and pre-data companies. But the capital is definitely there, whether it's from the government, whether it's from DARPA, whether it's from strategic, whether it's from VCs or others. So that's been the exciting thing for me. In addition to Nisha's credit, as she mentioned, her backbone, and I've seen a lot more women in the VC area, which is very exciting, especially for a dad with two girls. And then just from a side note, a lot more women-focused founders that we're doing more investing and women solely VC groups. So all that's very exciting. But as far as the capital and the flow, lots of term sheets, lots of deals, scrutinizing them as much as ever, and it's an exciting time.
Yeah, I would make one point there that it's not always a good thing, right? What's happening in the market is that funds came to market very quickly. They've got an immense amount of committed capital. So the dry powder that is existing in the market right now, whether it's for early stage growth or private equity, is still far in excess to, I think, deal quality, right? So what I've seen at the growth and even like Series A stage is some of these funds, they have to invest in something, right? They're holding all of this capital that they've called from limited partners, and founders know they have that leverage, right? So the best deals are actually getting bid up to really high valuations, and the middle sort of deals and the bottom aren't getting funded at all. The other sort of perversion you have in early stage investing is in growth stage as well, is that because funds have gotten so big, right? They used to be, $100 million. Now they're 500 to $1 billion. A single fund has the ability to mark up its own companies. So we've seen companies that are at 100 million valuation, then, A16Z goes and marks their own company up at $1 billion, but they've only reinvested, say, $50 million. And then they go mark it up into $4 billion, right? And there's really not outside pressure on whether that valuation is justified. But also, as a limited partner, I would be asking yourselves whether you think that that is a good use of the incremental dollar that the portfolio can allocate, or is that really that they're shoring up their investment so that their paper returns look good so that they can raise their next fund? And what's good about early stage is, nobody really cares what Andav Capital and Nisha Desai as a sub-$50 million fund does. So there's no signaling risk if I don't re-up in a certain company. I can look at every deal and say, is this going to be the best opportunistic use of this dollar? If so, I'm going to take my pro rata and invest, but I don't feel wedded to the need to. But Sequoia and A16Z and Tiger, they kind of have to.
So are you guys looking for earlier exits then as a result of this change in the market? Because it seems like a lot of the capital that's downstream, is pulling back at the, series C, D, E. Your thoughts?
Oh, my thoughts, or I thought it was
Yeah.
So, what's the question again? Sorry, Marty.
Earlier exits.
Earlier exits.
Oh, no, I'm not looking
Yeah.
for any.
Because
No,
C,
I'm
Yeah,
not.
I'd say no.
D, E are
No.
pulling back.
No. For us, 3 funds, all of us, we're not looking for early exits. I'm also in the business of betting on unicorns. So I think, it's interesting. So if you run an early stage fund, let's say a 15 to 25 million, if you bet on 1 or 2 companies out of that 20 companies or so that were unicorns, or let's say $10 billion valuation, you're good. You don't need to make any early exits. And because a lot of those funds were invested, we just started investing in 2020, 2021, and this year, we got a 5-7 years timeline. So we're actually, especially early stage, this year, next year, a lot of them are well capitalized. So we're no rush to exit.
So are you primarily a co-investor or a lead investor?
Cohen, well, mostly co, or not a lead in early stage. Yeah.
I think I have a different view. IPOs used to happen at less than $1 billion in the tech market, and after only 7 or 8 years of operating. Right now, IPOs and SPACs are happening a decade or 12 years after companies are being founded. So, one, we've seen in the public equity markets that before insiders are even allowed to sell, right after the lockup period expires, the company's already gone down in valuation several turns compared to where it IPO'd or where the last private investors invested. So one of the things I see, so I focus on fintech, but I also look at market structure and private markets, is platforms that are allowing folks to take liquidity. So I don't have a blanket statement. We have a different investment philosophy. We're not looking for just unicorns. We believe you can make an outsized 5x, 6x return in an early stage portfolio, not just chasing ideas on paper and unicorns. And we've done that as we have a 6x MOIC right now. But one of the things I look for is if I think a company is overinflated in valuation and it's not sustainable, if we have a big stake, I'm interested and open to taking some of that money off the table and selling in the secondary market. And we're going to see more of this. In fact, we're seeing it right now. And I think a lot of family offices and people who are in late stage investing are a little, disappointed that their managers, their investment managers, or their family offices themselves didn't take money off the table. And I think you've got to do that because that's also what family offices want. And so there's an important distinction that I think is overlooked when folks are selecting managers. And that's, what is the primary LP base of a specific fund, right? So we focus specifically on family offices, which are, taxable entities, in fact, high tax, right? To your point earlier, versus a lot of limited partners are endowments and institutions that are tax exempt. So, if you go back to Markowitz theory, you cannot optimize a portfolio for both taxable and tax exempt limited partners, right? So some of the investment choices that managers will make will be focused on their tax exempt LPs, because those are usually bigger and will be around for the subsequent funds. So they will recycle capital and recycle management fees, which means you as a family office aren't going to get, liquidity early. Even if something exits within the first 3 years, they'll take that money and reinvest it rather than giving you back the money and allowing you to decide what to do with it. The other thing is there's a lot of tax advantages for investing in early stage, like 83B and QSBS. And if you're optimizing towards a tax exempt LP, you're not going to really consider that. Whereas because we're entirely focused on taxable, high net worth and family offices, we're making investment and exit choices, also considering the post-tax return.
Yeah, just to Marty's question, I don't think at least the companies and groups I'm working with are looking for earlier exits, there is a lot more uncertainty due to gas prices, the economy overall, interest rates. So maybe a lot more questions, but it still goes back to the core. What's the run rate? What's the opportunity to grow the business? Who can we do a partnership, collaboration, JV deal with to grow it? How can we just, instead of focusing on United States, how can we go global? And all those partnerships. So I don't see that changing, but there are people more nervous than they were maybe just a few short months ago, because expenses, supply chain issues, all the above have increased. I will say one, Nisha mentioned the IPO. I probably brought 4 or 5 months ago several clients to a group that I work with to do IPOs, and like everyone else knows, that's definitely dried up. When that comes back, I don't know, but it's going to be at least 6 months to a year. I mean, others will know much more than me, but yeah, definitely not going to early exits at this point.
Corollary to that question that Marty asked, are you doing anything differently when you finance the companies right now? Take them longer into the process, since that A round, B round might be delayed or non-existent.
So I'll give a couple examples. So first of all, the reason why I also don't take early exits is every single company I invested, there are about 10 of them now. I said, especially in early stage, I said, look, you're my brother or sister, so I go to war with you. If I need that to make that capital call to some of the major VCs, I'll go get it. So because early exit, you also need to get approval from the company's founders, right? And likely you're probably taking discounts. So I just don't do that. Our funds don't do that, but that's okay. Everybody's got a different strategy. But what we've done is advise companies, say, hey, if you're able to raise 3, think about raising 4 or 5. We'll push up a valuation a little bit. That's okay. If you can get the demand, go do that. So earlier this year, a UK-based company, which is a similar model to a company called Updater, they raised 5 million. And originally they wanted to do 3 and then do a bigger round. Another good example called Big Ticket, which is also early stage, backed by FinVC, and we co-invested with them directly, and we also advised them to raise more. So we're advising those companies to sort of give more capital in the early stage to buy them more time, so they can get through this tough time. But 2 really interesting facts I want to talk about is that we are starting to see good companies, really good quality company, no matter it's early stage or even Series A, Series B, they're getting oversubscribed. So one company, I was with the founder from the beginning. When I first met him, he's got 750,000 committed to his cap table. Now he's got 3.75, and he only wants to raise 2.5 or 3. So he's had to turn the capital away because how good him and his co-founders are. And another good company, from a good friend of ours, Tracy Chatwell's portfolio company, the Recurrent Health. And I think it was 2-week turnaround. I was thinking about allocating some family capital money into this round. And Tracy was very nice about it. But then she goes, I'm so sorry, the CEO told me to oversubscribe. And that was a $60 million raise. And it was, snap your finger. Like, there are a lot of capital. And I think a lot of capital were raised in 2020, 2021. So if your fund structure is, let's say, 7 years or 7+ years, if you're patient the last couple of years, you're still going to have a lot of capital to deploy in the coming month and years. And this is actually an amazing time to do that. And also, go ahead.
I guess it was like an all-in podcast where they said that 80% of Tiger's VC when they raised last year was already deployed.
Well, that's their fault.
I'm just saying.
I believe it. I believe it. Yes.
So there's a lot of interesting things said about Tiger. I think one thing that folks haven't realized is they still have dry powder. So, a lot of people are poo-pooing them, but it's actually really risky for early stage investors, because what's going to happen is there's going to be a down round, right? And all of the early stage pref investors are going to be washed out and converted to common, right? And Tiger's going to say, or a big fund is going to say, I'm only going to put, $50 million more into this company if, it gets recapitalized. And there's not a lot of people who can so casually deploy big checks, right? So actually the huge valuations and the top evaluations in a distressed environment favor those funds who actually will have leverage because they have cash and dry powder. That's on the late stage side. So that is one of the reasons. Again, I underwrite every investment decision, not so that it's a unicorn, but so that it's a healthy business and It's not M&A, but it can win in a number of ways.
You're typically the lead investor?
No, we co-invest. Sometimes we lead at pre-stage, but it's small checks. And again, different philosophy. I mean, I think there's a lot of ways venture has changed in the last decade that the average LP just isn't aware of, right? It used to be that you would say, I'm a seed investor and I write, 50 to 100K or $500 to $1 million checks for 5% ownership, and ownership was a big thing, right? But now with valuations so high, you can't really get that same ownership unless you're a big fund. So I think you've got to reconsider portfolio construction and also diversify across vintages and sizes, right? So we do early stage, some Series A and B, and then when we get access to really good oversubscribed deals and might get preferential access or be able to get a small check-in, we will go C and D, and that's pretty unusual for the market. So again, I think that the Tiger will still have one of the last says, unfortunately, and a lot of people can say they've done things that are unhealthy for the ecosystem, but that's capitalism, and welcome to competition.
Yeah, I'd say everyone, especially in the venture space, is still looking for a good deal. I mean, tomorrow Olga's going to talk about a deal with a former CEO of Google, Eric Schmidt's the chairman of the board. He's put in his own money, and she can give you more details about their raise. But I mean, that company is skyrocketing, and I'm trying to think, not SpaceX, the other company. Anyway, and there's others. I could tell you on the medical device life science side, working with a spin out, just to give you an example, some exciting technology. Spin out from University of Utah that they're making sperm cells from infertile men using stem cell technology. On the women's side, people may be familiar with babies and cord blood, but there's a lot of data analysis going into menstrual blood and how they could use that from a stem cell and put it in, use it for some amazing technologies. So if the science is right, if the team is right, in the venture space, there's some really good opportunities.
So you mentioned that the SaaS margin are like close to 90%.
Yeah.
Now that AI is becoming pervasive across software,
Yeah.
right?
Yeah.
AI SaaS has a lot more infrastructure costs because the data is very expensive,
Right.
and costly. Do you think that the margin will come down? Or?
Yeah, well, I think the margin will come down, but still the software margin is great, right? I mean, if you look at consumer CPG or even e-commerce, I mean, those are the spaces where they're going to take a very big hit in this if the rate continue to come up, right? Because their margin traditionally has not been good. So software overall margin's always been great, and it's very easy to scale. And now you add AI, because AI is sort of an upgrade of the technology for the software side of it. That market opens up more. So, by the way, I'm the one of the company that got oversubscribed in early stage. It was AI software for supply chain. It was actually trying to build that infrastructure for the supply chain industry, where small business or even medium-sized business, they're allowed to use this software to get notification on, hey, we're running low on inventory in Asheville, North Carolina. But by the way, our stores in Charlottesville are having more inventory. So stuff like that, that opens the door for more investment in this space. But the key for AI space right now is there are a lot of people, they're trying to scam. You have to take a look at really how strong their teams are. Ideally, you want to take a look at the demo, because I've seen early stage decks that they say they're going to do something like that. And when I do the background check with two of my really good friends who are experienced software engineers at Apple, and they're like, there's no way they can build that with that team. So that's what I see, more important, the due diligence side of it rather than the margin. I'm actually not so worried about the margin at all in this space. Yeah.
One thing I would keep in mind is that, the SaaS boom in the public equities and private markets really happened in 2018. Now there's a SaaSification and the Web3ification of everything, just to sort of be appealing to investors. But in 2018, there were probably a dozen public B2B SaaS companies. Now there are close to 100, right? And in the B2B SaaS place, how do you win? You have to get those big Fortune 500 companies. So in my view, even though we were extraordinarily successful in the public and private markets, investing in SaaS from 2018 to 2020, I look for diversification, because I think there's going to be a lot of consolidation, and the Snowflakes and the Cloudflares and the Twilios that are already public, have very large balance sheets, are going to either buy up companies or just do what Facebook did in social, which is replicate. So just because the SaaS margins are great, I don't think historic success there is indicative of future for early stage. So we are really, I read research reports from all the big banks, and I'm looking in the transcripts for, the CEOs to say what they're focused on. And I think that's a risk that many other VCs don't. Marty.
So we had a conference 10 years ago with SB Angel and Bob Bozeman, who had been Ron Conway's partner on Google funding. And, we talked about what was the technology? It was like this, micro technology, right? And you know what, you have to think about things like one year they're big in VC and the next year they're not, because they become ubiquitous. It's just understood they're going to be there. And I'm kind of in that place with AI right now in SaaS, as you just said, where everything's expected to be that way. So is there really an edge in investing in that space, since the big players will move in that direction as well? So, what's the next thing?
I was going to say, on the AI space, I chair the med device group. I work with a lot of big, med device companies, of course. There's an AI component to everything. In healthcare, they call it, many of you know, precision medicine. So, and it's really, it can be just an individual basis. So a lot of genetic testing, diagnostic technology in the area, that's really exciting and, quite frankly, somewhat frightening from a privacy standpoint. And do you want to know all this stuff about the future? So that's really fascinating. But AI is huge. It's going to get bigger, as Didi said. And it's the data, no surprise to a lot of you in the room, is really, that's a whole separate valuation. I've had many healthcare companies and other med device and other companies come to me and say, we have all this data. How can we monetize it? How can we use it, whether it's in the cancer space or other areas? And it's something that I still think we're still actually early stages. People may disagree with me on that, but in the AI, that how to analyze it and make use of that data is getting something that we're going to continue to work on, and it's going to be a bunch of unicorns in that area.
Yeah, I'm with Pete on this. I think we're still currently in the boom, maybe early stages of that boom. Maybe the next 3 to 5 years, we're going to see more. Web3 is about maybe 5 to 10 years away. And I think that's what Mark Andreessen said. He was talking about that the sort of SaaS and AI boom is right now. It's happening. So I don't think this boom is going to stop anytime soon. But obviously, we're not early, because we're starting to see a lot of companies know that late stage, early stage, they're already here. But doesn't mean this, doesn't mean the TAM is not big enough. I think the TAM is big enough, but so I'm in.
I guess maybe cross-disciplinary application of it is good. With AI is good.
And then the other thing,
vanilla AI.
Yeah.
IBM didn't do too well with it.
Yeah. And then the other thing, one last thing I want to bring up is, if you want to talk about moat, software probably have stronger moat than consumers or even non-software, right? Because this company I've seen in the CPG or in the consumer space, we're talking about chocolate milk, chips, water company, and those companies, anybody can do it. But if you want to build something like AI or SaaS, you need the best technology. You need the best tech people, best software engineer, and these people are not cheap. I see the rates they're getting from startups, because I was part of a couple of negotiation. Two of my best friends, they're software engineers. They were CTOs, and they were negotiating with a startup, and then they were like, Apple's really making me really comfortable. It's hard to leave. So I'm bullish on this field. I think the next couple of years will be tough, because the public market is kind of choppy and company might not be able to go public. But if you plan sort of 3 to 4 years down the road, you're going to see companies go public again, or even get acquired by Salesforce or large sort of tech companies. Yeah.
Which vertical industry do you think are underpenetrated by SaaS? Like, where we could say a new SaaS company comes in, they gotta be in this industry because the rest are saturated.
I do think the supply chain is very interesting. If I look at it, there's one really big company called Celonis, and they kind of dominate in a lot of, they dominate kind of in the large enterprise area. And then there's another company called UiPath, and they're trying to, do the AI and sort of everything in that field as well. But pretty much that's it. That field is wide open, and the timing is completely right. Everybody's dealing with supply chain issues globally. And I buy stuff I came back from a boarding school reunion, and they have this 125th anniversary merch. I ordered it. It's been a month. Like, they say, hey, sorry, we're dealing with supply chain issues. everybody's dealing with that. And I actually see that supply chain is just going to drag a little bit. So this is something I think it's going to be super interesting this year.
So just to Didi's point real quick, when we think of Google, we think of Microsoft, we think of all the big tech companies, even if you look at Facebook, what's not known enough about them, we have executives and friends that work at them on the healthcare side. So from a SaaS data standpoint, analyzing that, the fact that they're even doing so much work in those areas is a good indication of the need. I mean, healthcare industry, what is it, 1/7 of our economy? And they're focused on it. So that, I think, they're doing more, but I think they're going to do even more in the future.
Yeah, I think
I-
digital, oh, go ahead, sorry.
No, I was gonna say that I would just want to bring it back a little to VCs and what VCs are.
Okay.
About 10 minutes,
All right, sorry,
What's that?
10 minutes.
10 minutes.
Okay, so Nisha, what are the misconceptions that people have about VCs, and how do you, as a small VC, differ in your approach and your approachability by people who do want to invest in VCs?
Yeah, I think I touched on some of them already, but one of the things is just my investment philosophy. I don't think you have to invest in just unicorns. You will read a lot about the power law curve. I've modeled it out. I take a lot from the hedge fund industry, and what I do is I actually have a proprietary model that I've developed where I look at the risk profile I want to create for my limited partners, and then I back out from there ownership stakes, the amount of reserves we would have, et cetera, rather than taking a sort of cookie cutter, we're going to own this percent of a company and be seed only. And what that does, it creates a barbell of risk for my LPs, right? We're concentrated in some early stage companies where I'm going to be very active, and I think I can be value add and actually create higher valuations and then release them on to bigger firms who will give them all the operating help. Then we also, like I mentioned before, some Series C where it's relationship oriented and can get access to a really good company. I'm not going to be, they don't need Nisha Desai to help them when they have like Bain Capital and, Kleiner Perkins at their disposal. So we're just riding along. So I really look to how do I optimize my human capital for the portfolio exposure we're trying to create for limited partners, because the average family office, according to the Silicon Valley Bank report, invests in about 10 VC funds. So if all of them are highly specialized, right? One is biotech, one is, something else, and maybe 2 are in real estate. We just had COVID happen. That's a lot of concentrated risk, right? I think one of the reasons why family offices want to invest in venture and why we partner with them is because they want the information flows. They want to ride off of my market knowledge and diligence. So I'm able to see a lot of deals across the market, and I say, look, this one isn't right for us, or we're going to participate, but we're not going to take a large amount of round. You can come in direct on this because it fits your strategy. And they like that. So again, partnering with family offices, understanding what their goals are rather than being adversarial, and same with the founders. I think that a lot of people don't realize that at early stage, unlike public equity markets, like the terms aren't all standardized. Right now in the market, I have companies that are raising at safe valuations, 15 million, and other people who are buying them, same company, at 40 million, right? It's not a single priced round. And who gets the 15 versus who gets the 40 is all based on relationships. So if you're value add at the early stage, and this is part of our model, we get warrants, advisory shares. It's very cash efficient for the amount of equity and ownership upside we have. And so it's very asymmetric. And you can only get that if you're really value add with the founders and have a reputation for that. So that's built into our strategy. And I'm not sure bigger firms who have to just sort of take whatever terms the founders give them will get that sort of same preferential exposure.
I just add just one thing, family offices that we're working with, they're pretty focused. One very hot area that we're seeing is the vertical farming area. It's really not just United States, it's growing internationally. So that's really exciting, and people learn about it. It's really fascinating how it's controlled farming. So we're seeing a lot of investment and excitement about that. Separately, I know Marty very smartly or correctly has an ESG panel tomorrow. That's another area, all the environmental issues, and especially there's a big push, obviously decarbonization technology, desalination technology for water, and then specifically for the plastic technology. In fact, Marty was very helpful. Last meeting we had, I mentioned a company that, for those of you that may know, there's 1 billion pounds of almond waste. A lot of almonds made in California. There's 1 billion pounds of waste. There's a company that's looking at using that waste instead of plastic technologies, making different products. And then the waste stream, it's actually biodegradable. And then others, I just learned this, my last point. I learned it a couple of years ago because I've been working with this client, but these large, very large fishing nets that are used in the ocean, when they're done using them, they're made out of plastic. So it's recycled, and through some patented technology we're working on them with, it's now being used, and that is being transformed into kitchen tiles or home tiles. So I think I'm really excited to see what's going on in the ESG discussion tomorrow.
But just a quick point, as on my way up here today, I read an article that BlackRock is actually divesting a lot away from the ESG space.
No, that's unfortunate.
So,
Go ahead.
did you see that?
No, well, I saw an article which is interesting, is that they compared S&P portfolio with the BlackRock ESG portfolio, and the top 10 or 15 holdings are like very similar. So it's almost like, you know, why would you
pay a better premium?
Yeah, you pay more premium on the BlackRock ESG. So
Let's talk more about venture. So, you know, in my world, there's a gazillion early stage venture. I mean, everybody who's ever been through Y Combinator says,
Yeah.
great, I'm starting a VC fund now, because I got Y Combinator for
Yeah.
right? And you can get access to it, which doesn't seem believable,
yeah,
right? So what really differentiates? I mean, I think you've got a great strategy because you're really focused on the tax aspect, which if I was a family office, there's actually some great reasons to get in on the earliest stages because of tax advantage aspects of investing in venture, right? And you're investing as a co-investor, it makes perfect sense as well.
well,
But, you know,
I think, you know, the thing about me is eventually if I do my own fund, or if I partner up with, you know, raising sort of funds that are, let's say 25 to 50 million, we're happy to lead. We're just in a point that one of the fund one sort of just depleted, and then we're actually looking to raise fund 2, but we're waiting on timing. And the other 2 funds, we're not really a traditional VC. We don't like raise and then deploy. We're raise and deploy at the same time. So yeah.
right, so I'm asking, what are differentiating factors that you would, you know, see? Because in my world, there's so many startup VC firms
Yeah.
in Silicon Valley right now. It's
Yeah.
unbelievable. Austin, Texas.
Yeah, the
right?
taxi drivers and SF are starting VC.
Right, exactly, right.
So one thing that I think about, you know, there's this market standard of 2 and 20, right? 2% management fee, and there's not a lot of compression on that in VC land just because it's not a huge AUM base, so the GPs aren't getting fat off the management fee. We actually need that to operate, even if we're not taking a sizable salary. So I always ask family offices, like, you're paying the standard 2%. What kind of horsepower are you getting in your general partner? Do they understand how to read the term sheets and look at the pro forma and do the diligence and negotiate hard and manage the teams, and also be a therapist to the teams at some point, and figure out how to get more information for their founders so they can de-risk the company before it gets sort of sidetracked? And I think it's hard to find all of those competencies in one person, but that's the reason why my game selection is early stage venture, because I've been an operator. I've been an employee number 4 of a unicorn that IPO'd. I've been through distressed. I've, you know, spent time on Wall Street for a while. So all of those cross-functional competencies are really value add to early stage founders, which helps me win deals, right? One of the things I think is really underestimated is preparation. So solo GP, I don't meet with founders just because they send me their deck or there's a warm intro. I don't meet with them. And Forbes, I told Forbes this, they quoted me like, unless there's something there, right? Because it's a waste of time. I read my diligence before, I ask my questions, I send emails, I don't get on the phone because it's not a good use of time. And founders really respect that. They always say, you ask the best questions, and that allows me to sort of get into rounds. And never underestimate the power of a very well-crafted email to even late stage founders about what I can do for them, risk I see in their business and intros. That's how I'm getting access to some of these oversubscribed Series C deals and preferential terms at the early stage. So I think we're definitely more versatile within our GP. And the last thing I'll mention is every fund has fees that they can and expenses they can charge to the fund, right? It eventually comes out of the LP money. said before that in early stage venture, there's the biggest dispersion in GP talent. So you have some GPs that are getting money because they tweet a lot or they look the part or whatever, right? But they know basically nothing about managing money or tax or audit or finance or term sheets. So they outsource everything to service providers. Who's paying for that? The fund, the limited partner. So what that does is it reduces the investable capital. For every dollar committed capital, you're getting less invested in actual companies, which means your return on that invested capital has to be 1, 2, 3 times higher than, say, somebody like myself who's able to internalize a lot of that analysis. And last point I'll make is, I had, for example, 3 conversion deals that converted to preferred equity in the last quarter. And I was looking at the pro forma myself without my counsel. And, the lead counsel for the lead VC fund represents them. The company's counsel represents them. So who represents the early stage venture fund, right? Not many people are looking at the pro formas very deeply. And I did. And in one of them, 3 of them were wrong, right? And wrong in the sense that the early stage investors who weren't paying attention, the family offices and H&Ws, were going to get less equity than they were entitled to. So I went back to these top firms. Kirkland & Ellis led one of the deals, and there was a 10% difference in my ownership, my actual legal ownership interest versus what the pro forma had. And I said, I'm sorry, you got to go back and you got to restate the amended, operating agreement. 10% is material to me. I'm sorry, nobody else caught it.
I always wonder in venture, and by the way, I think you should bring up on the funds because you got the money. I always wonder why in venture there are like multi-strat venture funds. I know Andreessen Horowitz kind of is that, but I mean, it seems like there's a really great opportunity for multi-strat, which takes advantage of things that are hot when they're hot and when they're not.
Yeah, no, it's funny that you asked that. So I actually said that like my ideal would be to run the smallest crossover fund because I do really actively manage public equities, and I'll be candid with many of the LPs and family offices. Facebook is at like a 12 times forward P multiple, S&P's at 16, right? Like I'm not going to tell you to go put your money in a liquid asset unnecessarily. Go to the best opportunities. And so if you are an investor who can see across both of them, I would love to have had dry powder that I could put into liquid publics that are going to get a bump, right? And then deploy that into privates. Not everybody is going to entrust a general partner to do that, which is why it doesn't exist. But that's where eventually I want to go.
I have a lot of questions for Pete. So again, I'm trying to differentiate funds. Anything that you look at in a fund is going to be different because again, everybody tells me, oh my gosh.
So this is going to be it's going to be a segue into the next. Where's is it Sean? Where's Sean? Is Sean in here?
Yeah, Sean is speaking.
Oh, he's going to be on. So the segue to Sean is we look at areas, hot areas. So whether it's next area is immunotherapies, there's a case that there was a judgment for $1 billion. Obviously, chip technology is very hot. And a lot of the things that Olga is going to be talking about tomorrow, quantum computing, national security type things, a blockchain, all these things are hot. So once you get an area that you can kind of, in my job, you got to see the future, whether it be the Jetsons or something else, that TV show, for those of you old enough to remember that, we try to look at that. The name I forgot before, some of you may know that the company, they launched the into space relativity. Yeah, Tim Ellis came here maybe 5 years ago, was raised in the $75 million fund, and now their company. Remember Tim Ellis, this guy from Relativity. So anyway, so I look at the areas. Then of course you got to look at the teams. Without the team, you have the best players you can imagine. Yeah.
Can I just ask one more question?
No, we're out of time. I'm sorry, guys, I take it offline. It's the room next door.